Hello and welcome back to another episode of Darwin Investors. Today we're going to talk about how to value stocks. Right now we just went through a market correction and we're currently in it actually. And what helps me cope with the correction is I have a very good grasp of what I own. I know the value of what I have. And hopefully by the end of this video, I can help other people know the value of what they own and then help them cope in times like this. So let me go ahead and share my screen here. And what we'll first do is talk about, just real quick, how to prepare for a market correction or how to cope with a market correction. So we have to put the correction in context. The market is volatile. It's not a feature, it's not a bug, it's a feature. It just happens. And volatility is just a part of being in the market. And unfortunately, if you can't handle some volatility, maybe the stock market is not the place for you. But hopefully by knowing what you have, I can help you get back, dial in some of the anxiety that you might have by holding certain stocks. So if you look here, since the S&P 500, since the Great Recession in 2009, there have been 6 declines in the S&P of 10% or more. We just had another one today, so that would be 7 declines. So it's just something that happens. But I like this piece of advice here. Just remember this one simple piece of advice. When in doubt, wait it out. Because if I look at the S&P right here, you can see that we're sitting at 4,410 points on the S&P. We can see that the past month has been really ugly, down 8%. But what I don't know is I don't know where the next 400 points is going to be. I don't know if it's going to be up. I don't know if it's going to be down. But I do know this. I do know, with history being a guide, the next 4,410 points will be up. Okay? So just kind of relax, understand what you own, and just take a breath and just kind of wait it out. That would be one way to deal with the market correction. Second thing that we can do is just kind of remember your goals. Why did you come here? Why did you start putting money in the market to begin with? It was, I'm guessing, because you had a little bit of money there and you're trying to invest for your future and you're just trying to sack something away. You're just trying to take a little bit of money and turn it into a little bit more money. But unfortunately, that isn't the way things always seem to work out for us, because when we do, then that's the way things start, but it's just like we lose perspective. Remember to get your perspective. Collect yourself. Now, remember that when we first started, it would be like this. This would be how your portfolio probably looked. A lot of ours do. This is when we're brand new and we're dumb and we don't know what we're doing. All we're doing is getting in those little value stocks, things like Home Depot or maybe Costco or something like that. And our stock market looks something like this. Our portfolio might look something like this. It's a little bit like the S&P. Sometimes it goes down, sometimes it goes up, but over the long haul, it goes up. But then all of a sudden this happens, wham! And for me, this was probably Lucid, probably did this one for me. But once you make this $3,000 in, say, a day, you start getting a little bit less happy with making $50 or $75. You crave this. This is what you want. You forget, you don't like this anymore. And then this happens. And you're rolling around, you think you're king of the world, and then this happens, wham, and it happens really quick. And now you're below where you would have been. You're like, dang it, I should have just kept my boring old stocks. Well, there's only one way to get it back. I'm gonna double down on some other crazy stock, and it'll go up, and then finally, hopefully you learn your lesson. But by the time you're done learning your lesson, let's hope that you're kind of closer to here and not there. And so right now, what I'm saying is it's a good time to gain perspective and go back to your roots, and that's basically going back to your old time value stocks. And so Another suggestion here is to focus on asset allocation, which would be diversify your portfolio. And then last but not least, you may also want to focus on the investing strategy on the stocks you own, opting for value stocks in lieu of growth stocks. Remember, value stocks are companies you think are undervalued based on their profits and expenses. Growth are those targeting rapid growth by running up large corporate tabs that can make them more vulnerable during economic downtimes. In layman's terms, this means value stocks are, generally speaking, companies that make net income, and growth stocks generally do not. So what we're going to do is we're going to learn how to value these stocks. And so how to value stocks? So value stocks, it basically works on earnings per share. And earnings per share is net income divided by the number of shares. And before you click off this video, I'm going to show you this is not too bad. So let's see here. So when we go over here to the Schwab account, I'm looking at Microsoft. Now I'm going to show you how to do this. It's very, very, very simple. So Microsoft has a share price right now. The share price is $296.37. If you divide that number by the earnings per share, 8.9457, you get their PE ratio, which is 33.13. They went up a little bit today, but 33.13 is their PE ratio. And so you've got a price to earnings ratio, a forward PE, and a PEG ratio. The PEG ratio shows me the forward earnings of this company, what the growth, the forward growth of the company, or what the analyst at Charles Schwab believes it will be. So if you divide this by 2, you could see that they believe that Microsoft is going to grow at 16.56% next year. We can also look on this. We can see that they've got a market capitalization of $2.2 trillion, and they have shares outstanding of 7.5 billion. So all this is laid out here. Now, but like I said, the easiest back of the napkin thing to do is take their share price, divide it by their earnings per share, and that gives you a price to earnings ratio. When I look at Microsoft and I look at their historic valuation, I know that the PE ratio of Microsoft that it historically trades at is roughly 27. So you can see it's been trading around 34, 35, 36, 34, 35. And then I can see that 27, 27, 30, 27, and it goes up to 40. And then it just kind of like, this is when it was a little bit lower. The company wasn't growing as fast back then. And so I can tell that the PE ratio of this stock normally trades around 27. So if I go over here and I know that at the worst, Microsoft is going to trade at 27, all I have to do is take the number 27 and multiply that by their earnings per share, 9,457. And that means the worst that this stock will dive to with a 27 PE is $241.53. That's a long ways down from 296. But it's not that simple, because remember, we think that Microsoft is going to grow at 16.5% this year, right? So when thinking about that, if it's going to grow at 16.5%, then that means that these earnings per share, 8.9457 times 1.165 gives me a next year's share price, a 2023 share price of $10.42. Now let's say that again, if Microsoft were to grow instead of at 16% next year, let's say 14 or 15%, not about 15%, times 1.15, then that would mean that our 2024 earnings per share will be $11.98. Now stocks trade for future value. Now if we just say $11.98 at its current share price, $296.37, and you divide that by $11.98, which would be their their earnings per share, provided they don't, dilute their stock, which they don't, but like their earnings per share and their new PE in 2024 will be 24, and they generally trade at a 27. So then I know this. So I know that this is a good price for Microsoft. I can expect that in 2 years, I will at least get my money back. And that might sound like a long time, but remember what investing is. Investing is trying to take a little money now and turning it into more money later. And plus, I'll make other videos that can show you how you can make money off of your shares while you hold them. But just knowing this, though, that at $296 with a pretty modest rate of a pretty modest revenue increase, because if you look at the revenue for Microsoft, it just trends straight up. So I can comfortably say that I believe that Microsoft will be able to carry on as they always have done for the next couple years and be sitting at a 24 PE. So this is a good price. Let's take another more extreme example. How about Nvidia? So Nvidia is one that a lot of analysts, they're like, oh, it's so expensive, it's so expensive, it's so expensive. And it is. Today, it's trading at a 72. But when we look at Nvidia trading at a 72, let's go ahead and calculate this out here. 233.72 divided by the earnings per share, 3.2393, you're going to get roughly 72.16 or 72.15 in this case. Now, Nvidia, it's expected to grow much faster than Microsoft. So you divide that by their PEG ratio, and you'll see the analysts expect to have it 39% growth this year. Now, I think this might be undershooting it, because if you look at it, last year, they grew at 65%. So 65% down to 39%, I think that's probably pretty reasonable to think that they could grow at 39%. And so we take their current price per share, 3.2393, multiply that by 1.39, and that would be their price per share in January of 23. Now let's say instead of 39, they go from 65 to 39. Let's say that the year after that they trade times 30 times 1.3. Then their 2024 earnings per share will be 5.85. Stocks like this one that have this rate of growth, they trade on a valuation, generally speaking, not always. Valuation is an art as much as it is a science, but they trade at a valuation usually about 4 or 5 years out. So they went from 39% growth in 23 or 22 to 30% in 23 times, let's say 20% or 25% in 24. So 5.85 times 1.25. And then that would mean that in the year 2024, we're expecting they would be $7.31 a share. So let's see if Nvidia is overvalued. So $7.31, so 233.72 divided by $7.13. So it's trading at a forward PE in 2024 of 32. So it is a little bit pricey, I would agree, but you're paying a premium for the growth and for the innovation of the company. So that would be how we would value on a price to earnings ratio basis certain stocks. So PE ratio is basically how much you pay for every dollar of net income. In the case of Microsoft, it's currently sitting at 37. That means for every $1 of net income Microsoft has, you're paying $37. And so you have to know, is that expensive or is that cheap? Well, rule of thumb. Now remember, it's a rule of thumb. Less than 10 is a bargain. 10 to 15 is cheap. 16 to 20 is good. 20 to 25 is fair. And over 25 is getting expensive. Now, this is for value stocks, okay? Microsoft is considered a growth stock. And these stocks, and really the valuation of all stocks, is sector dependent. And now let me demonstrate. So here's Finviz. This is Finviz is an application. It's free. You go to Finviz, you go to Screener, and let's see. All stocks are not created equal. So the stock market is divided into 12 sectors. Let's go to the financials. And let's say we're going to go to diversified banks. Okay, now let's look at these diversified banks. Look at these price to earnings ratios for a lot of these banks here. And let's start with the largest market cap ones so we know which ones we're talking about here. JP Morgan, Bank of America, Wells Fargo, and so on and so on. So we can see that in this sector, 14 is an expensive price to earnings ratio. 14 in other sectors like tech would be very cheap. Let me show you what if we went to consumer cyclical and we looked up, say, home improvement retail. Okay, now we're looking at these here and you see these numbers are larger. Lowe's has a price to earnings ratio of 20. That's a much higher than banks, but you're not comparing Lowe's to a bank. You're comparing Lowe's to other home retailers. And so when you look at this, Lowe's is reasonably priced. It's cheaper than Home Depot. And really there's only two, it's just these two. But it's a reasonably priced stock. It's got a PE of 20 and for its sector, it looks good. I've never, Our House, I don't know what that is. Haverty, never heard of it. Grow Generation, I don't know. LL Flooring. So usually also when trying to cope with a market correction, it helps if you know what the stock is. That gives you more confidence in what you're holding. So getting back to Microsoft, they would be in the technology sector, and they would probably be as a software application. And then we would look at market cap here. And okay, so it's not in that, but okay, well, in any case, this helps illustrate the point that software, technology and software is higher price to earnings ratio. You can see that Shopify is at 34, Salesforce is at 121, Workday is, most of them are dashes. Most of them don't have any earnings at all. These are ones that operate differently. They operate on what's called price to sales, and we'll get into that in just a little bit. DocuSign, yeah. So you can see that a lot of software stocks, technology stocks, actually they trade on price to sales. And now here is the software for where Microsoft is under infrastructure. Microsoft trades at a 33 PE, Adobe's 51. Oracle is at 23, Square is at 123. So you can see that for this sector, most of them, again, have no price to earnings ratio at all. So you can see that for this sector, Microsoft trades at a nice valuation. Stocks that come in with price to earnings ratio of like 51, I would say higher than I would say 50 or more. Those would be your growth stocks. They're still earning income. They're earning net income, but they're your growth stocks. They'd be more like Nvidia, the one thing that we just showed you. All right, so as I just said, the stock valuation is sector dependent. Now, stock valuation is also nuanced, and a lot of it has to do with market sentiment. Like there was a time not that long ago, if you had a stock that wasn't making any money, but it had a reasonable price to sales ratio, we would say, oh, it's got a price to sales less than 10, it's a buy. Right now, a stock not making money is not a buy. Secondly, right now the banks and the oil companies are trading pretty. They're on fire. They're doing pretty well. If you're in those sectors, you've been doing okay. Everything's down, but if you're in those two, you're feeling the least amount of pain. Certainly, the most amount of pain comes from the tech sector, and that's because you noticed from looking at Finviz that many of those stocks are not profitable. You do not want to be in profitable growth stocks when a market correction happens. And so when I say that it's nuanced, so oil, people are saying now oil should go to about $100 a barrel. Well, when you look at the price of oil stocks right now, remember the market is forward looking. The price of oil right now is about $82 a barrel. So do we think then that oil stocks right now are trading on their current valuation of $82 a barrel? Or do we believe that they're trading on the possibility that they go to $100 a barrel, and if they go down to $55 or $70 a barrel, that the oil stocks will actually fall down pretty hard? See, I tend to think that the market is trading right now that oil is trading at $100 a barrel. Same with banks. We're anticipating at least 2 and up to 5 interest rate hikes this year. A lot of these banks that are interest rate dependent, such as Wells Fargo, Bank of America, those stocks are going up, and especially Wells Fargo. Wells Fargo is especially sensitive to interest rate hikes. And so those stocks have been going up, and I think that's anticipation of multiple rate hikes. And stocks, the reason why growth stocks go down is because this anticipation of the rate hikes. Stocks that are growing, remember we said that they have to borrow a lot. Now, when they borrow this money, they're paying it back at a higher price than what they borrowed it for, technically speaking, with inflation, when you take inflation into account. And that's why they go down. And so the stock market is based on fundamental analysis, like we were just doing with price to earnings, and they're also done on technical analysis, but that'll be something for another day. So how do we value a stock? We saw a lot of those tech stocks that had no earnings. How do we value those stocks? Well, those stocks are valued on what's called price to sales. And so let's go over here and look at a couple of stocks. So I'm going to show you a couple of very similar stocks, and then I'm going to show you the difference between the two. Here's DocuSign. And so we go over to DocuSign. We can see that DocuSign currently trades at $121. We can see that it's not currently profitable, has a forward PE. They're anticipating that this stock will probably be profitable next year. Right now, it's trading at negative 58 cents a share, meaning that's why it has no price to earnings ratio. So we go over to their statement. We can see here that they made $1.45 billion last year in revenue. So 1.45 billion is what they made. When we come over here, we can look at their market capitalization is 23 billion. So 23 divided by 1.45 means that they trade at a price to sales of 15. Now, there are times when that's not bad, and there are times when having no earnings at all, regardless of how little this number is bad. And we're in one of those cycles right now. So like I said, it's an art. Sometimes this is not that bad, and given that if they're growing enough, and sometimes it is bad. And right now it is bad. Let's look at Teladoc. I wanted to show this because there's a reason why I'm showing these two stocks. So stick around because this is super important. So let's go look at Teladoc. And so you saw that DocuSign was a D and Teladoc is an F. Now let me show you why. So their market capitalization is 11.7 billion. When we go to their statements, you can see that they make 1 billion. Now I don't need a calculator for this. I can see that if you make 1 billion and your market cap is 11 billion, they're trading at 11 times price to sales. Why is it that Teladoc is an F and DocuSign is a D? So the reason is right here. Let's go to DocuSign's 10Q. And the way I got to this is basically you can always find any public company's information. I'm going to just quickly go through that real quick. Let's go to the DocuSign. DocuSign Investor Relations. And if you do this and you click on SEC filings, you will find what's called a 10Q. A 10Q, the Q stands for quarterly report. So the Q is for quarterly. So you'll go to a 10Q and you'll bring it up. So they're 10Q filing. And so I've already got it up right over here. And so I can see that 9 months ending, they made $1.52 billion. Last year in 2020, through 9 months, they made $1 billion. But here's the most important thing that you can get from this. You can get their earnings per share, net loss per share attributable to common stockholders, basic and diluted. We can see that 9 months ended 2020, they lost 92 cents a share. We can see in 9 months ended 2021, they only lost 20 cents a share. They're headed in the right direction. We can see for the last quarter reported in October, they only lost 3 cents a share. If I had to bet, I would bet that DocuSign, the next time they report, this number will be positive and DocuSign stock will go up depending on market sentiment. It's going to finally get a PE ratio. It's something that the market has been looking for. They have a path to profitability, and that's important when valuing a price to sales stock. Now let's take a look at Teladoc. Okay, Teladoc had very similar sales. Revenue 1.4 billion, DocuSign was 1.5 billion. This thing is growing at a clip of 100% year on year. That's impressive growth. But the problem is that their net loss per share is in 2020, with less revenue, they lost $1.17 a share. In 2021, with twice the revenue, they lost $2.68 a share. This company is headed in the wrong direction. See, in the quarter ended in September 30th, 2020, they lost 43 cents. Quarter ended 2021, they lost 53 cents a share. Again, that's why this company is an F, even though they're 11 times sales, when DocuSign is a D, even though they're 15 times sales, because DocuSign has a path to profitability. So, like I said, not all price to sales stocks are created equal. So let's go ahead and wrap this up. Just remember to go ahead and stay the course. Know what you own. I hope this helped some investors and hope I've been able to get you through these tougher times. Please, if you got anything out of this video, remember to like and subscribe and maybe hit that little notification bell. Until then, we'll see you next time. Bye.